When people see all this tech stocks plummeting down for 30-40%, where do they look after that? Dividends and passive income. That's what we're going to be talking about today. Hello everyone, Alex is here. I hope you're doing well. I hope you're staying safe as always. And it is time to talk about passive income, consistent passive income, because we're going to be watching at stocks, at high dividend stocks today that I'm eyeing on right now, that I added to my watch list recently, and I also invested in some of them already. Why passive income, why it is important right now, and why actually dividend stocks right now at the top of the list for almost all the investors, not only dividend investors, but also all other investors. And one of the reasons for that, because of the inflation and what's happening with the consumer purchase index these days, especially in Canada, and especially in the US, it's even worse there. What's happening with the growth stocks this year? The tech stocks plummeted 30-40% since the beginning of the year. This is crazy. You're not getting the returns you would like to get. And that's why passive income dividend stocks are on top of all this right now. They give you this sustainable, consistent income every single month that you can rely on and use it for whatever reasons you need it to, for paying bills, paying the rent, buying groceries, or even just reinvesting back to your investment account. And the real question for you, for Canadians right now, is that are you ready to experience even worse market situations until the end of the year? If you are, good for you. If you are not, you probably should diversify your portfolio into more stable blue chip stocks, and especially dividend stocks that give you these sustainable returns every single month. And what about this inflation consumer price index? What about it? It rose by 3.4% over last year. What? 3.4% inflation just within 1 year? That's crazy. And that means that almost all the different goods out there that you buy in groceries and toys and different construction material and everything out there, the prices rose by 3.4% over last year. This is crazy, and that basically means that you just lost 3.4% out of your dollar value. This is nuts. The average inflation rate is actually 1 to 2% annually, and seeing this 3.4% is actually pretty crazy, and you don't know what's going to happen next and how you can make sure that money you hold, that your portfolio that you hold is not sitting in your bank account as cash. That's what around 60% of Canadians do, because all the money that is sitting on a checking account, they're just losing the value, and that's it. You're not getting anything back. They're not working for you if they're sitting there. That's why investing is very important. And 3.4% spike in consumer price index is actually the largest over the last 10 years. Just think about it. All right, enough talking. Let's see what stocks we have today, what high dividend stocks I prepared for you today. Let's take a look. And the first one about today is going to be probably one of the most popular ones. And a lot of people actually ask about it in the comments. And I think a lot of people actually invest into this stock and have them in their portfolio. I have them in my portfolio as well, which is Algonquin Power. And the ticker symbol is AQN.TO. And Algonquin Power is actually an attractive dividend stock for a couple of reasons. First, it pays an attractive dividend yield of 4.5%. Algonquin Power is actually a serial dividend grower as well. They just raised the dividend by 10% recently, and they have grown their dividends every single year for the last 11 years. And given the history, it's not hard to see that this company is lined up for a very good future, and they're going to be increasing their dividends even more going forward. So Algonquin Power is actually rolling out a $9.2 billion capital plan. It expects to accrete annual 8 to 10% earnings per share growth all the way to 2025 only from this. Algonquin Power has also a pretty good exposure to US, and why that is important? Because I think that the Biden administration with its infrastructure and renewal plan can play a pretty big role in the Algonquin Power growth. And moreover, the other good part about this stock that I think is very important also, besides all the dividends you're getting and all this passive income on a regular basis, is that it's also a growth stock. They've been growing like crazy for the last 5 to 10 years, and they actually expected to grow even more going forward. Let's take a look what we have here from our metrics for Algonquin Power. So their market cap as of today is around $11.4 billion. So it's a decent sized company. They've been growing gradually for the last 10 years, and they are actually expected to grow even more going forward. Their current dividend yield is around 4.5%, and their 5-year average dividend yield is actually at 4.3%. So that means that the stock is right now is a little bit undervalued compared to its historical data, and it represents probably a good buying opportunity considering what the share price as of today. But if you just look at what company is doing, what they're looking for in the future, and what the environment is for them in the future, I think it's a very good investment opportunity for actually any type of investment portfolio. And as I said, they've been growing their dividends consistently for the last 11 years. They pay out their dividends on a quarterly basis, so you'll be getting these dividends paid out to you every single quarter, and you'll see this increase of dividends every single year going forward. Their payout ratio is actually a pretty sustainable number, is at 40%, so I'm pretty sure they can sustain their dividends going forward no matter what. And regarding their growth, over the last 10 years, the share price grew by 220%, which is a huge number considering what this company is doing and what the dividend they're paying on top of their growth. So it's definitely a stock that you at least want to add to your watch list and keep an eye on it. And they've been beating their earnings quarter after quarter for last year at least. Their DRIP actually pretty affordable, is at 2100. So if you want to set it up and reinvest back all the dividends you are getting in order to purchase a single share of Algonquin Power for free, you would need to invest 2100 into this stock. So it's totally worth it. You can set out with the Quest trade. I have a video here, actually here, where I talk about it, so you can go and check it out. Their beta parameter is 0.21, so the stock is going against the market volatility on the short term, but if you consider to invest in this company for a long term, you shouldn't worry about that. Algonquin Power offers investors a very rare mix of dependability, passive income, and growth. And I expect that this company is going to be performing even better going forward, and there's no reason for them to not do that, and there's no reason for them to stop paying this consistent dividends on top of that. So I'm definitely investing more into Algonquin Power in the nearest future. Let me know in the comments what you think about Algonquin Power, and if you have it in your portfolio or if you don't. What are your thoughts? And let's move on to the next one, which is going to be a real estate investment trust, Smart Centers, and the ticker symbol is SRU-UN.TO. And Smart Centers is actually one of the largest fully integrated REITs with the best-in-class portfolio featuring 168 properties in communities across the country. Smart Centers has approximately 10.3 billion in assets and owns around 33.8 million square feet of value-produced retail space, which is occupied by 97%. This is great. The companies keep getting this consistent cash flow that allows them to pay a pretty good dividend yield of 6.3%. The company plummeted by 70% during the last year market crash, but they also already recovered from that, so they definitely can show that they can sustain this difficult market situation and also pay out this pretty good dividend every single month. Yeah, they're paying dividends on a monthly basis, so you would enjoy passive income for 6.3% every single month. They've been increasing their dividends consistently for the last 7 years, so there is no reason for them to stop it. I think they can perform even better when we're back to normal, when the whole thing is reopened and everyone is allowed to go everywhere else. And all the investment that the company is doing actually will start bringing even more cash flow back to their pockets, back to our pockets in terms of dividends. And let's take a look what we have here from our metrics for Smart Centers. Their market cap is around $4.9 billion. Their current dividend yield, as I said, is around 6.3%, and their 5-year average dividend yield is actually at 6.1%, which means that the share price that they're trading at right now is potentially a little undervalued. So it represents a pretty good buying opportunity as of today, because they're still priced a little lower than they should be based on what the company is doing, where they are right now, and what they're showing in their earnings. Over the last 10 years, their share price grew by 16%, so it's not a huge growth because it's not a growth stock, but it still has this sustainable growth over the long-term period, which is good to see. But also consider that the share price dropped by 70% last year, so this 10-year share price appreciation is also accounts for that. Their drip amount is also at a pretty affordable level, is at $5,800. So it means that if you invest into this company $5,800, you'll be getting enough dividends back that you can use to reinvest into this company to purchase a single share of this company for free. I mean, with your dividends. That's how it works. Their beta parameter is 1.22, so it's not a very volatile stock, even on a short-term period. And of course, there are a lot more stocks to watch, there are a lot more stocks to invest to, but I think these two are actually very interesting right now. They're in a very good spot. They can be added to any type of portfolios you have, especially dividend portfolio, and I'm eyeing those. They're on top of my list. So let me know what you think about those, and if you have them in your portfolio already, or if you're going to be increasing your positions for this too. With all that, thank you for watching. Don't forget to smash that like button, subscribe to my channel, hit the bell, and I'll see you around. Stay safe out there. Cheers, bye.